Welcome to De-Risk Investing. Today, we're dissecting Arista Networks, ticker ANET. This company is at the absolute epicenter of the AI revolution, providing the high-speed networking switches that are the central nervous system for modern data centers. The stock has had a phenomenal run, but it's recently pulled back over 15% from its highs, and we've seen some insider selling. So, Alex, this brings us to the big question. Is Arista a premier growth compounder taking a healthy breather, making this a generational buying opportunity? Or is this pullback the first sign of a classic value trap, where a sky-high valuation is finally meeting the reality of a slowing economy?
Sarah, that is the perfect framing, and the tension is immediately visible in our models. Right now, the stock is trading around $131, but our discounted cash flow models, which are heavily weighted towards that long-term AI build-out, are spitting out a fair value north of $200, with one FCF model even suggesting a value near $225. That's a massive disconnect. The model is essentially pricing in sustained 20% plus revenue growth for the foreseeable future, fueled by the insatiable demand for AI infrastructure. The market, on the other hand, seems to be getting vertigo from the valuation and is starting to price in the risk of a macro slowdown hitting enterprise spending.
Let's dig into that macro environment, because it feels like the entire market is walking a tightrope. We have economists warning of a hiring recession and unemployment ticking up, which could signal a pullback in corporate spending. This is critical for Arista, as their fate is tied to capital expenditure budgets. But the counter-narrative is that the AI build-out isn't just a cyclical upgrade, it's a secular supercycle. We just saw news that OpenAI's Stargate data center got approval for over a gigawatt of power. That implies the demand for Arista's core products isn't just strong, it's almost non-discretionary for companies that want to compete.
Exactly, and Arista's financial engine is built to capitalize on that. Let's look at the numbers that matter. Revenue growth has been fantastic, climbing from under $3 billion in 2021 to a run rate of over $7 billion. But here's the real story. Operating margins have expanded from around 31% to a stunning 42%. That tells you they have immense pricing power. Now, for the fuel, we have to talk about the balance sheet. In the world of rising rates, Arista has zero debt, and their cash pile has surged to nearly $3 billion. This isn't just a strong balance sheet, Sarah. It's a fortress. They can weather any storm and fund their own growth without diluting shareholders. The only minor flag is some insider selling, but with a balance sheet this strong, it looks more like diversification than a warning sign.
A fortress balance sheet and elite margins are compelling, but they often come with a premium price tag. This brings us to the quality debate. Is Arista stock trading at a discount to its intrinsic value, or is it simply, and perhaps justifiably, more expensive than its peers? Let's put it in context. Alex, how does Arista stack up against the competition, and what are the technicals, the chart itself, telling us about investor conviction at these levels?
This is where the picture gets nuanced. Compared to legacy players, Arista looks expensive. Its forward PE is nearly 40. For context, Dell is at 11 and HP is around 7. But you get what you pay for. Arista's operating margin of 42% absolutely crushes Dell's 8%. Investors are paying a premium for a much higher quality, higher growth business. Now, let's look at the chart through our three clusters. First, trend. The long-term trend is a clear bullish continuation. The 50-week average is well above the 200-week. However, the intermediate trend is flashing a breakdown signal, with the price recently falling below key moving averages. Second, momentum. This is unambiguously bearish. Indicators like the MACD and Awesome Oscillator are showing negative divergences and have been pointing down for weeks. Finally, volume. This is the most interesting cluster. On-balance volume shows a bearish divergence, meaning distribution was happening on the way down. But more recently, the Chaikin money flow has ticked positive, suggesting quiet accumulation is starting. The chart looks like a coiled spring after a sharp correction.
So we have a conflict. The fundamental quality is undeniable, but the short-term technicals are weak. And this brings us to sentiment. On one hand, Wall Street analysts are overwhelmingly positive, with over 85% rating the stock a buy or strong buy. On the other hand, the price action and volume flows you just described suggest professional money was selling. This leads to the classic rhetorical pivot. Who is right here? The analysts selling the long-term AI story, or the traders betting real money on the short-term trend?
The smart money data suggests traders are positioning for a bounce, not a collapse. Let's look at the battlefield. First, short interest is incredibly low, less than 1.5% of the float. There is no significant organized bearish bet against this company. Second, the options market is skewed heavily bullish. The put-to-call ratio is just 0.38, meaning call volume is dramatically outpacing put volume. From a psychological standpoint, traders are clearly using this weakness to buy upside exposure. The key levels to watch are the strike prices with the most open interest. There's a huge wall of calls stacked at the $135 strike, which could act as a near-term magnet or resistance. On the downside, the biggest concentration of puts is way down at the $110 level, which traders are essentially flagging as the ultimate floor.
All right, let's bring it all together for the verdict. Arista Networks is a quintessential growth compounder. It's a best-in-class operator with a pristine, debt-free balance sheet and expanding margins, positioned perfectly to capitalize on the multi-year AI infrastructure build-out. The recent stock pullback appears to be a healthy consolidation after a massive run, driven by macro fears rather than any company-specific flaw. The divergence between weak short-term technicals and strong underlying fundamentals has created, in our view, a compelling entry point. The bull thesis rests on continued robust spending on data centers, allowing Arista to maintain its technological edge and premium pricing. The primary risk to this thesis is a severe, protracted recession that forces even the biggest players to pause capital expenditures, compressing that elite valuation. Our final rating is *accumulate. This isn't an all-in moment, but a strategic opportunity to build a long-term position in a high-quality leader on weakness.
And here is how we would structure that trade. The strategy is to buy into this consolidation, using the recent lows as our guide. The upside target is a retest of the prior highs, putting our initial price target in the $155 to $160 zone. Our invalidation level, the point where the thesis is broken, would be a weekly close below the November low. That key support level sits right around $115. The logic is simple. A break below $115 would mean the buyers who stepped in during the last panic have failed, suggesting this healthy correction could be turning into a more serious downtrend. We're risking about $15 on the downside to make a potential $25 to $30 on the upside.
That's all for this week's deep dive. Thank you for your time, and remember that this podcast is for informational purposes only and not financial advice. All investment decisions should be made with the help of a qualified professional.